Investors, meanwhile, monitoring news on the coronavirus, but billionaire hedge fund manager Ray Dalio thinks the outbreak's hit to the global markets is probably exaggerated. Speaking at the Milken conference in Abu Dhabi today, he said, quote, because of the temporary nature of that, I would expect more of a rebound. It most likely will be something that in another year or two will be well beyond what everyone will be talking about. Joining us right now to talk about this and so much more is Barry Knapp, managing partner at Ironside Macroeconomics. Do you agree with Mr. Dalio?
Yes, absolutely. So the way I approached the coronavirus was, first of all, not to become an expert in something I had no business trying to become an expert in. But the way I framed it out was to think about, first of all, what's the potential risks to business confidence? And so I looked at that. Furthermore, from the framework that we've had really depressed business confidence through the trade war last year. And if you think about where China and the U.S. are right now in terms of just recovering from all that uncertainty, it's highly unlikely that you could have a hit to the order of magnitude of what happened in May or August of last year. So business confidence is already depressed. It's on the upturn. It's unlikely that we would have a hit like what we had in May or August, which means the stock market decline was likely to be less than it was in those two episodes as well, which were 6 to 7%. The other thing, or the other dynamic here, or concern, is what it does to supply chains. For me, it's likely to be far less impactful than the Great East Japan earthquake and tsunami in 2011, which essentially shut down the global auto industry for 3 or 4 months. And the reason I say that is, first of all, it's unlikely to last 3 or 4 months. Now, I'm not becoming an expert in coronavirus, but weather will get better and it'll probably start to fade. But more importantly, that 2011 incident was the starting point for companies no longer stretching their supply chains all around the world.
Right.
And so they've started to go towards local sourcing. And it was you guys that actually interviewed the Honeywell CEO in Davos, and he said, that's our model. Right? We locally source.
Right.
That incident, Thai floods in the same year, the trade war, all those things have moved companies away from that. So, again, the hit to the supply chains is unlikely to be nearly that order of magnitude. So, for me, this is a transitory event that we'll move on.
But the question is, the market also seems to think it's a transitory event already. So, is that overplayed, underplayed?
Well,
in terms of a week or two ago would have been a great time to buy on a relative basis to where we are today. The question is today, on a relative basis, a good time to buy?
Yes. And the reason is once you push past all this and you think about the drivers, for me, there were 3 main tailwinds that were likely to persist through April or May. Those are the liquidity being created from QE or not QE4, the improvement in global trade and manufacturing, the business confidence resurgence. You can already see it. Capital spending is improving. We have a boom going on in software and research and development spending, which, to Mike's earlier point about the mega caps, that's why it's happening. I mean, the effects of the Tax Cuts and Jobs Act, we have 15% R&D spending in the tech sector going on right now, 12% for the S&P 500. So that's tailwind number 2. And then tailwind number 3 is just the condition of the U.S. consumer, which is off the charts. So those things, for me, are the reason that I was bullish for the first 4 or 5 months of the year until the Fed pulls the plug on not QE. Then we get a little bit of an uncertainty shock.